Hi everyone, welcome to the session. In this session, let's go through this particular question. This is relating to consolidation profit and loss account between two entities, which is Park and Sam. And you are requested to answer these particular questions A, B, C. Okay, so these questions are relating to A, cost of sales. You need to identify the group cost of sales. Then part B is relating to the finance cost, the group finance cost, and finally the net profit of the group. Now you are given the following notes. The following notes are relevant to the preparation of the consolidated financial statement. First one is the Park acquired 70% interest in the equity share of Sam on 1st May 2011. Now see, this company was acquired on 1st May 2011, and the financial statements, the financial period ends on 31st December 2011. So as you can see, this was acquired during the period. Okay, so the financial period start from 1st January 2011 until 31st December 2011. Okay, however, the company was acquired in between, so this was acquired after 4 months, 1st May 2011. So this is very important, this date of acquisition, because prior to this is pre and this is the post. So therefore, whenever you do the consolidation, line by line consolidation, you need to consider the revenue and cost proportionately. So let's say how it is, what is the assumption on allocating these revenue and cost in the question. So this company, the Park, has acquired 70% of interest of Sam, so therefore 30% is the non-controlling interest. This is the structure, non-controlling interest. Then during the post-acquisition period, so which means they are talking about this period, Park sold goods to Sam. So Park has sold goods to Sam. Park is the parent and Sam is the subsidiary company. 70% acquired and sold goods to Sam, $120,000, including markup on cost of 20%. Okay, so P has sold goods to S, $120,000, and the profit margin is, that is markup is 20%. So markup 20% means what? It is on the cost, but this is the selling price. So therefore you can't directly apply 20% to identify the profit margin. So in that case, what you should do, so basically if you take your cost as 100, the markup is 20%, which is 20. Your selling price will be 120. Okay, so which means this 120,000, if you divide by 120,000, if you divide by 120, which is the selling price, times 100 will be the cost, and if you multiply by 20, that will be the profit. So the profit is 120,000 divided by 120 times 20 is going to be 20,000 is the full profit kept on this particular transaction. Okay, 1/4 of these goods remain in the inventory of Sam at the year end. Okay, now here you need to identify who has recognized this profit. These goods have been sold by parent company to the subsidiary company. So therefore the profit is recognized by parent company. Okay, since the profit is recognized by parent company, we don't need to split this 20,000 profit into the parent and the subsidiary. Okay, we don't need to split because the entire profit is recognized by the parent company. Okay, however, if the profit is recognized by the subsidiary profit is profit belongs to the parent company as well as the minority non-controlling interest. Okay, so parent as well as a non-controlling interest. So therefore that profit has to be segregated into the parent and the non-controlling interest, NCI. Okay, so this has to be segregated. Now in this case the profit is recognized by the parent company. The entire 20,000 has to be removed, but here what they are saying is 1/4 of these goods remain in the inventory of SAM. Now when you take the intercompany transactions such as sales and purchases between sales purchases between parent subsidiary has to be eliminated. Why? Otherwise that can lead to double counting. This will lead to double counting. So by eliminating intercompany transactions, the financial statements present only transaction with external parties. You need to show the transactions with external parties only. Okay, so that will provide you a clear view of group's profitability. So because intercompany sales and purchases do not contribute to the overall economic activity of a group, so they are basically merely internal transfers between parent and subsidiary. These are internal transfers between parent and subsidiary, do not result in real profit or losses. So this is like you are transferring money from one hand to the other. So no actual profit is generated from this exchange because it does not involve an external party. So once it is sold to external parties, then only you can recognize. Otherwise all intercompany transaction has to be eliminated, otherwise that will lead to double counting. Please remember that. Okay, before we answer these three questions, let's try to build up the consolidated income statement, the line by line. What we need to do is we need to add the parent and subsidiary company, all these items line by line to get the group net profit. Okay, finally what they are saying is all items of income and expenses in SAM statement of profit or loss account accrued evenly during the year. So when it is stated that income and expenses accrued evenly during the year, so it's typically means that you can divide the total annual figures of the subsidiary company by dividing by 12 to obtain the monthly figures. So then you can proportionately you can take the post period figures. Okay, so these figures you can obtain by dividing all these numbers by 12 and the period for which the company was acquired. Now for this purpose, 1st May 2011 until 31st 12 2011, it is 8 months period. Okay, so whatever these numbers, what you need to do is you just divide by 12 and multiply by 8. You can obtain the post-acquisition period, the revenue, cost and all the other expenses and the net profit. Now let's take the group. So what you need to do is line by line you need to add the parent, the Park and Sam's revenue. So 1086 plus 595, you can't add 595 because you need to take only 8 months. So basically 1086 plus 595 divided by 12 times 8. So that will be the subsidiary company revenue for this particular period, the post acquisition period profit, the revenue. And from this what you need to do is you need to eliminate intercompany transactions. The Park has sold to SAM, so therefore that 120,000 is included in the sales. Okay, so therefore you need to eliminate 120,000 plus there is unrealized profit. See, 1/4 of these goods remain in the inventory. So now we calculated the unrealized profit, which is 120,000, of which we calculated the profit 120 is the markup, times 20 is going to be 20,000. Of this profit, 1/4 of these goods remain in the inventory. So therefore 1/4 of this profit will be the unrealized profit, which is going to be 5,000. So this 5000 has to be removed from inventory. This has to be removed from stocks or inventory. So when you reduce stocks, your cost of goods sold will increase, right? So when you when you deduct this unrealized profit, your cost of goods sold will increase. So therefore, uh, that adjustment has to be made here in the cost of goods sold. Okay. So now here straight away you can take the revenue part. 1086, 595 divided by 12 times 8 is going to be 396 minus 120, that will be 1362. Then we have cost of goods sold, which is 620, okay, plus uh, 353, you can take 353 divided by 12 times 8, okay, and from Sam's cost of goods sold you need to eliminate 120, which is intercompany. So the P has sold to Sam, so P will recognize in revenue, and Sam, it will be purchases, it is included in 353. So therefore from this total you need to eliminate 120, plus since 1/4 of the goods are remain in the inventory of Sam, what has to be done? This 5000 unrealized profit has to be removed from inventory. So removing means the cost of goods sold will increase. So once you add this 5000, these are in thousand, so you will get the correct cost of goods sold. So that's going to be how much? 620 plus 353 divided by 12 times 8 will be 235. This amount is 235. Okay. 620 plus 235 minus 120 plus 5, it's going to be 740. Okay, your cost of goods sold is going to be 740. So your gross profit will be how much? 622. Your gross profit is 622. Then administrative expenses, the similar way you need to do. 245 plus 129, you take, divide this by 12 times 8. So your admin cost will be how much? I will take it here, admin cost. 245 plus 129, this is divided by 12 multiplied by 8. Take that number. So that's going to be, this number is going to be 86. 86. So 86 plus 245, so that will be 331. 331. So that amount has to be deducted to get the operating profit. That will be 291. Then you need to take the finance cost. The similar way, 55 plus 32. So 32 divided by 12. This has to be divided by 12 times 8. That amount will be how much? 21. So 55 plus 21 will be 71. Just deduct this. Sorry, 76. 55 plus 21 is 76. The total will be 215. Okay. Then finally you take the tax amount, 44 plus 25 divided by 12 times 8. So this amount is how much? 17. Okay. So 44 plus 17 will be 61. So therefore your group net profit is going to be 154. So this is the group numbers. If you take a consolidated number, revenue is 1362, your cost of goods sold 740. So the gross profit is, this is the gross profit, 622. Then from that we deducted administrative expenses. This is administration expenses, and then this is the finance cost. This is the finance cost, and this is the taxation, and this is the group net profit. Now let's try to answer these questions. Select the correct calculation for cost of goods sold, cost of sales. Now you are given 3 answers. You need to select the correct one. Okay. Now what you can do is you can go to this particular cost of goods sold calculation. How we have arrived at this particular number 740. So you can see we took 620, the parks cost of goods sold 620 plus 353 divided by 12 times 8. So we added that. Okay, so as you can see, 620 plus, yes, 353 times 8 divided by 12, yes, this is also correct. Then you need to eliminate the intercompany transaction of 120 because it is included in the cost of goods sold and the purchases. So we need to eliminate. So you don't add this. So therefore this is not the correct answer. Out of these two, we deducted 120. Yes, 120 deduction, 120 deduction. Then you need to add back the unrealized profit which we calculated here. Okay, 1/4 of these goods remain in the inventory. So that 5,000 has to be added. Not a deduction. We are not deducting from the inventory. We are deducting from this is the cost of goods sold. As I told you, when you deduct from closing stock, your cost of goods sold will increase. So therefore you need to add back. Okay, so the correct answer is third one. This is the correct answer. Okay, then the B part, what is that finance cost? How did you calculate the finance cost? 55 plus 32 divided by 12 times 8. Okay, so you can see 55 not minus plus 32 divided by 12 times 8. So this is the correct answer, the second one. Third one, select the correct formula to calculate the non-controlling interest share of the consolidated profit for the year. Now what you should do is, okay, in order to calculate the non-controlling interest share of the consolidated profit or loss, so what you should do is, out of these SAMs, the 57,000, so this is the 57,000. That 57,000 you should take how many months? 8 months. The acquisition period, post acquisition period is 8 months. If you take 57 divided by 12 times 8, it's going to be 38. Okay, so this is the subsidiary profit that was divided by 12 and times 8 because of the post acquisition period. So 38, from this 38 belongs to the parent as well as the non-controlling interest. Parent is 70% and non-controlling interest 30%. So when you take that, 30% of 38 is going to be 11.4 and 70% is going to be 26.6. So that's going to be how much? 38. Okay, so therefore the correct answer for this is you take the subsidiary profit which is 12 multiplied by 8. Okay, then the NCI percentage. NCI is 30%, but we don't deduct what do you call the NCI share of unrealized profit because the profit is recognized by, as I told you earlier, the profit is recognized by PARC. Okay, so therefore that is the parent company profit. In the consolidation inventory we will deduct, but when you calculate the non-controlling interest, that unrealized profit is not adjusted in the subsidiary company's what do you call the profit adjustment. We don't deduct that. So therefore the correct answer is the third one. Okay, now we'll try to do a reconciliation. Now our net profit is 154, the consolidated net profit. So this part belongs to PARC, part belongs to NCI. Okay, that total should be 154. So we know the NCI is 11.4. Then how about PARC? PARC profit is 121. So we take 121 plus the post acquisition profit of 26.6. So that comes to how much? 121 plus 26.6, 147.6. 147.6. So 147.6 plus 11.4 is 159. So you are not getting this number. Okay, why is that? As I told you earlier, from this profit, that unrealized profit of 5,000 has to be eliminated. Okay, so thereby this amount will be 142.6. Okay, so thereby 142.6 plus 11.4 will be 154. Okay, so this is the answer for this particular question.